Imagine major banks and giant tech companies transferring billions of dollars worth of Bitcoin. Does that sound plausible? What if I told you these transactions were an illusion? Today, we're diving deep into Michael Saylor's unwavering belief in Bitcoin and why it might just be an illusion. Look, I have no stance against Bitcoin. I'm just being realistic. And at the end of this video, I'll share the shocking truths explaining why major financial players prefer other cryptocurrencies over Bitcoin. But before we start, don't forget to like this video and subscribe to the channel to support me for more content. Bitcoin maximalists like Michael Saylor claim that Bitcoin will be the cornerstone of the global economy in the future. They even predict that Google, Apple, Microsoft, and major banks will transfer trillions of dollars in Bitcoin on the main layer, Layer 1. Sounds good, right? However, when we dig deeper, we see that these claims contradict technological realities. Why, you ask? First, it takes an average of 15 minutes to complete a transaction on Bitcoin's main layer. In a world where fast transactions are expected in daily life, this duration is incredibly slow. Think about it. Would you want to wait 15 minutes for a coffee? Or would a bank risk waiting 15 minutes for a multi-billion-dollar transfer? Of course not. This is where second layer, Layer 2 solutions like the Lightning Network come into play. Yes, the Lightning Network offers faster transactions, but it has its own problems. In particular, businesses need to hold large amounts of Bitcoin reserves to use the Lightning Network, which is a very costly obstacle given Bitcoin's high price. Does it make sense for a small or medium-sized business to acquire thousands of dollars in assets just to make an occasional Bitcoin transaction? Market reports indicate that most businesses are hesitant to adopt Bitcoin payments due to this cost and complexity. Michael Saylor describes Bitcoin as a digital capital asset, just like gold or real estate. According to him, companies will hold Bitcoin in their treasuries as a store of value and transact this way. But there's a big contradiction here. Giant companies like Visa, MasterCard, or Microsoft don't directly transfer assets like gold or real estate for their operational needs. They need digital solutions designed for instant and low-cost transactions. In fact, did you know that Microsoft's proposals to its own board of directors for Bitcoin purchases have been rejected multiple times? The reason is simple. Bitcoin does not directly serve their business models and technological needs. So what does? Stablecoins and fast, scalable blockchains. Major banks and tech giants plan to build digital payment rails, and the most preferred tool on these rails will be stablecoins. Why? Because stablecoins are digital currencies pegged to fiat currencies like the US dollar, and are not affected by value fluctuations. This means predictability and stability for businesses. The real issue here is that you cannot build stablecoins on Bitcoin's main layer. Bitcoin's technological structure is not suitable for creating complex smart contracts and stablecoin mechanisms. However, blockchains like Ethereum, XRP Ledger, XRPL, Hedera Hashgraph, HBIR, and Solana offer ideal platforms for developing stablecoins and other advanced financial applications. For example, Ripple, the company behind XRP, is developing stablecoins and interbank transaction systems to provide fast and low-cost solutions for international payments. This means banks can make multi-billion-dollar transfers in seconds and at a fraction of the cost. Similarly, Ethereum forms the basis for stablecoins and innovative financial products in areas like DeFi, decentralized finance, and NFTs, non-fungible tokens. Consider this. Will a payment giant like Visa process billions of dollars in transaction volume over Bitcoin, or over an XRP ledger or Solana network that completes transactions in seconds with minimal fees? The answer is very clear. The trillions of dollars in volume Michael Saylor talks about will most likely occur on such stablecoin-friendly blockchains. On-chain analyses show that institutional players' interest in these platforms is steadily increasing. Michael Saylor's insistence on Bitcoin is largely based on his own business model. His company, MicroStrategy, buys large amounts of Bitcoin and offers it to investors. This naturally leads him to glorify Bitcoin. However, the world is changing rapidly, and there's a huge difference between the crypto market of 10 years ago and now. There are now much faster, more scalable, and more functional blockchains available. So, the digital assets that financial institutions and large companies will use in the future will not be Bitcoin, as Michael Saylor predicts. They will be technologically more advanced cryptocurrencies that support stablecoins and meet corporate needs. Remember, the goal of these major players is not to store value, but to transfer value and do business. Therefore, technologies like XRP, HBR, Ethereum, and similar will form the basis of their future business models. I hope today's analysis helped you better understand the realities behind Michael Saylor's arguments. If you want to learn more about cryptocurrencies that are opening the door to major financial change, don't forget to subscribe to the channel and like this video. In the next video, I will analyze a very important development regarding XRP, which will give you a complete perspective. Don't miss it.